And this year is just about focusing on achieving positive cash flow. Mr. Brenz will talk about what that means. After that, we're going to spend a couple years paying down debt, growing, increasing our investments in research and development, and preparing for NASDAQ. As an issuer, I can tell you that I am regularly solicited by Wall Street banks to uplist. And in that process, the company would be given a whack of cash. The problem with that is retail investors would be crushed. Stock would be crushed 2, 3, 4 years before it recover. And our reputation might never recover. We're going to stay on the OTC in this 4-year period. We're going to hopefully work these sales up, work into profitability, straighten out the balance sheet. And when we do uplist, my hope is that we become a strong NASDAQ company, not do an overnight pipe and really continuously work for retail, because you guys are a big reason why we're here, and I appreciate you.
Thank you, Mark. Well, what a great time to be a team member at RAD. The dynamics that exist between the guys that I work with every day, absolutely amazing. I don't think there's anything that we can't do. But so I'm here to share some very dry financial information with you folks. No, seriously, though, I'm not here to talk about the financials. All that data can be gleaned from our SEC filings, our Qs and Ks. But what I am here to talk about today is something very near and dear to my heart, and that's cash. Right? I think everyone in the room would agree that probably the single most important thing for any early stage growth company is really cash preservation, generation. So on this first chart, it's kind of a telling story, because what it tells us is that March of 23 on the left side, which was the beginning of our fiscal year, we had a huge gap between the incoming cash, which is blue bar, and the outgoing cash, which is actually the green bar. But as you look across the months, you can see that the trend is actually looking very positive. And there's 2 reasons for that. The first being that we put together a very conservative top-line forecast. I mentioned this earlier in his presentation, that anticipated that we would grow our monthly revenue, RMR, by about $50,000 per month. And really, that's not a stretch. I mean, if you think about, if you know the retail side, or you know the pricing side of our products, that's somewhere between 25 and 50 units deployed every month that we can. And then that's really the place that we need to be. As you see, when we look at this chart and we're looking through the time frame of September 20, October, November time frame, blue bar starts to creep up on the green bar, and eventually somewhere right around the August 2024. And how are we going to get there? Well, this next chart will show some of the details there. Okay, so what we did here is we broke up our SG&A costs. We consider the SG&A costs to be the most controllable costs of everything that we do, right? These analyses, the prior graph and this one, do not include inventory spend, not include debt service. Those are things that are taken outside of this particular presentation. But what they do allow us to do is take a look at those costs that we deem to be variable or certainly controllable in the immediate period. And we looked at those as a team and determined where we could adjust our spending so that we could achieve this cash flow break-even point sooner than later. But the reality is, to move from $1 million per month, 700,000 is a huge task. And I think we've taken it under our wings very well. We've had some great success. A lot of the improvements I talked about today are already in place. Some are very near to coming on board if they're not already here. But summary, I think cash in a company like ours is paramount, right? And its management is critical to our success.
Wow. Applause. How many CFOs get applause? Wow, thanks, Tony. I want to share that Mr. Brenz, Tony Brenz, has pubco experience from three public companies prior. Absolutely thrilled beyond belief to have him.